Hi everybody. I wanted to do a review of round one to give people a better idea of the results, how to interpret them, and how to move forward. Okay, so the first area I'm looking at is the current points. And we can see here that a few teams got over 900 points, which is fantastic. They're beating 91% of every team that's played this simulation in the past couple of years. I think the database is up to 5,000 teams. So that's really great results. The anything over 600 is a really good result. You're beating more than 50% of the past players for this round one. We have a couple companies here that have very similar names, and also very similar results. So we'll have to go over that in a minute. Now, one thing about doing very well in round one, since this is a year-over-year competition, it's going to make it a little bit difficult to do better in round two. So it's sort of like if you got a 900 or 800 and above, it's sort of like getting a 4.0 your first semester. So next semester, it's going to be difficult to have a huge year-over-year change because you scored so high in the first round. So the second round, don't expect to get 900 points again. It's virtually impossible. But you're still, accumulated more points. I think you need an average of about maybe 400 points around to get an A in the project. So if you're well over 400 points, you're ahead of the game. So even if you pull back a little bit next round, you're still going to be ahead. So this is a very good showing of, I've never had a class do so well in the first round. So this is very encouraging so far. Now, the most important factor in doing well in this simulation is profit margins. Now, profit margins are what companies are striving for. Now, companies are not striving to make the best product to the highest quality for you. That's the advertising. What they're striving to do is make the most profitable product for themselves. And companies will lie, cheat, and steal sometimes to do that. Just look at Volkswagen. Now, not all companies lie, cheat, and steal, but all companies do put their profits first. So they want to make sure that when they make a product, yes, that the customer is satisfied and that it sells, but also that they're maximizing their profits. So if you took any time to look at your current gross profits, you would see that the current gross profits of the company were at 40%. So any team that stayed at 40% or were below 40% severely disappointed investors. Investors expect companies to always increase their profit margins. If you did any stock investing or you look at the stock market, anytime a company comes out with earnings and they disappoint on their revenues or the profit margins, their shares go down, investors are disappointed, the company's a failure. So if you don't increase your profit margins to make them greater than they were the previous period, you're going to fail your investors. And here we had 5 companies that failed their investors or failed to increase their gross profit margins, and that's going to cost you. And you see that these companies are the companies that did poorly in overall points, are here at the bottom of points because their profit margins did not really increase. Now, anybody above 40%, which most companies are above 40%, your profits did increase, and that's going to help you to do better in your, most of your ratios are based on profits. So having higher profit margins increases most of your ratios as well. Now, if you have profit margins in this high 40s or above 50%, that's maximizing pretty much. I think 50% is maximizing your profits for round one. And now that makes it difficult to increase that even further in round two, but not impossible. All right. So if we look at stock price, we could see that. Let's just pull back here. This is the number one team in points, AIC and AK Auto and RB Supercar. You see those. And now if we look in gross profits, we see that, okay, so they're all in the mid to high 40s. One company's AIC is 51. And you'll see that that's corresponding to stock price. Now, you see that these companies are in the high end of the stock prices, the top 5 or 6 companies. Now, with stock price, remember that it's about the gross profits of your company. It's about the increase of revenues at your company, and it's also about did you issue a lot of new stock or buy back shares? So if you issued a lot of new stock in the finance page, that will push your stock price lower because you have more outstanding shares to spread over your earnings over. If you purchase some stock back, that's going to decrease the amount of outstanding shares you have and help with your stock price. Okay, so return on equity. Now, with return on equity, you're just trying to balance your returns to the size of the equity you have in your company. So if you haven't borrowed a lot of money in debt, it makes it difficult for your return on equity to be higher. So if your company is under leveraged, this might be a little bit lower than you anticipated. And total points is the same as round 1 points because we're only in round 1. Operating profit margins, the difference here between gross and operating is basically your advertising. So your advertising lowers your gross and brings you to the operational profit margins. Now your earnings per share, and again, this is related to stock price. So if you issued a lot of shares, your earnings per share, it's difficult to really increase your earnings per share a lot if you're issuing a lot of stock. If you're buying back stock, that will help to increase your earnings per share. Okay, so you see that not necessarily the companies with the highest amount of earnings have the highest earnings per share because it depends on how much stock was issued. Return on assets, this is how well you utilize the assets you have. So have you did you have a low capacity utilization, a low asset utilization, meaning that you bought a lot of assets but didn't use them? You're going to have a low return on assets. But if you use your assets efficiently, meaning that your factories are at full capacity, close to 100%, then you're going to have a higher percentile rank here. And the net profit margins are going to affect any interest or taxes that you paid on your revenue. And you see that so some companies went from 40% down to 20% by the time they get to the net profit margins because you are paying for taxes and interest on any money you may have borrowed for the company. Revenue per share, again, is just the per share basis. And this here, again, if you buy back stock and you have the same revenues, your revenues per share will increase. This is all basic stuff you should have learned from finance or financial accounting, by the way. All right, and total asset turnover is looking at your assets compared to your sales. Okay, and you'll see that now. Let me just push it up. If you go into the simulation, you will see that there is an assessment tab for your team that will rate your performance from 1 to 5 stars and to give you hints also on how to improve it. All right, so let's look at some of the charts here. So here we go. This is the net profits for round 1, and you can see that we have 4 companies here that are really excelling in net profits. Then a bunch of companies that are doing very well, and only a few companies here that are low on net profits, which means you are most likely disappointing your investors. And it's all about the strategy of a company is really the bottom line of the strategy is how to maximize profits and revenues. Now, in the meantime, you're developing new products, you're developing new strategies against other companies to perform well, but the end of it all is translating those strategies into profits. Okay, points per team. This is just a visual. You can see these charts too when you do your review of your simulation. And we can see that stock price, there's a pretty good range from $9 to $17. So companies that understand their financials of their how to best position their financials in borrowing money and buying back stock and running their company and increasing profits had the highest stock prices. While companies that weren't as efficient had lower stock prices. All right. And this is just sales per team. So here, and we could look at the earnings per share. There's a big, we get from $1.91 to $5. 2 teams with $5 here. So you want to say, how did they maximize their profits? How did they get their earnings per share so high? And you can do that. These are just some per share market share charts. And you could do that by analyzing, you know, your company against other companies in the simulation. So let's see. Let me just go to my demo. And my demo is like your practice round. So what you want to do here, just to give you a quick idea, I'm gonna reset this. Okay, so I went in the individual practice and I did round one myself, just to give you an idea, because I don't want to pick any student's team and critically pick them apart, because students don't like that. So I am critically picking myself apart. Students love that. Okay, so I finished round one. I'm in round two. So the first thing I look at is my overview score, and here I see that a couple things to look at quickly. Now I increased my revenues, which was good. I earned points for that, but my quick ratio went down, so my points went down for that, and my debt ratio went. I'm sorry, my quick ratio went up. No, it went down. And it's my debt ratio that went down. And debt ratio is sort of when it goes down, that's a good thing because I'm lowering my debt compared to my equity. My profit margins went from 40 to 45%, which is good. It's a 12% increase. And my operational increased and my net profit increased. So I earned points in my profit area, which is what you want to do. And then if you look at my total asset turnover, that went down because I purchased a lot of assets but didn't use them efficiently. My equity multiplier, which is a little kind of chart down here if you want to look at it, it sort of helps you get a better understanding of your profits by your assets, by your equity. And my equity multiplier went down, so my company is not really that efficient as it was. Although, it went up, so my company is more efficient. Let's see. Return on equity increased because I increased mostly because I did increase my profits, but I also increased my debt. My earnings per share went from $1.90 to $4.77, which is good. And my return on assets were sort of flat. And my market capitalization, my stock price times my outstanding shares increased 100% or more, 180%. These are the year-over-year change, and the percentage change you get translates into points. So I'm competing against my last year's results, but I'm also competing against everybody in the industry. So if you are crowding me out and reducing my sales, that's going to affect my overall ratios and revenues and profits. So not only am I competing against everybody in class, all the other teams in class, well, in this case against computer players, I'm also competing against doing better against myself. So it's important to know where I am on these ratios because I want to do better next year too. And then if I look at my book value, went up, and my forecasts, I earned some nice points in my forecasts. My forecasts were very accurate, and that is good. So I'm going to earn points in my forecast. But now that if I earn a 1 or a 99 percentile in my forecasting, that means like I've got straight A's. So next round or semester, if I get straight A's again, I'm not going to earn any points in this area, but I could possibly lose points if my accuracy isn't close to 100%. So with the forecasting area, you can make some points the first round because the forecasting was terrible when you took over the company. But as you move forward and your forecasting is very accurate, don't expect to make points here. Now, I had a $19 million deficit, meaning that I spent more money than I generated in my cash, and I lost 100 points for that. So that's an easy 100 points to make, is to make sure that you have a surplus, not a deficit. So this, I knew I was going into it having a deficit because I wanted to kind of explain that, and I earned 684 points. So now the question is, what do I do in round two? So first thing you should do is go to this assessment tab here and check out your assessment area. And if you didn't do so well in any particular ratio, you can get these hints on how to do better. So that's one way to kind of self-correct what you're doing. The second thing is to analyze your charts. Now, if you go to the performance chart, an important area here is if you scroll down to market potential versus actual, you'll see that the blue is my market potential, how much the market wanted to buy my cars, and the yellow is what I actually sold. So here in economy, I gave up a lot of sales. I could have sold 2,300 cars, but I only built and sold 2,000. So the competitors got that excess from me. I maxed out on my sedan. My truck, I did get pretty close to my forecast of my truck, but my luxury, I forecasted 1,600, could have sold 1,800. It's a very profitable vehicle, so I missed out. So this will help me to look at my forecast better and think. I want to base my forecast on last year's market potential, not last year's actual sales. And I also want to look at the student user guide to get an idea of what percentile are these markets expanding, so I could better analyze my forecast for next year. All right. Okay, so let's go back. Now the industry tab is very important. I can look at the other players and see, okay, if I wasn't in first place, how did these other teams do? How did they build their cars? What are their returns and their ratios? And you might say, well, this doesn't seem very fair or very real world, but actually it is very real world, because if you want to look at any auto manufacturer that's public, if you want to look at GM or Ford or Toyota or Honda, you can look at exactly how they made their cars last year. It's on every sticker that's put on every car, and it's on the internet. You could look at their annual report and see what their financials were and their ratios. So it's very accurate that you can see other other teams or companies' past financial and operational data because they're public companies. And you should use this to say, what did they do? Who's the number one place team, and what have they done that differently than me that got them into first place, and kind of learn and build on their strategy. And that's what companies do. Oil companies do that all the time. If one oil company is pulling away and they're having great success, the other automobile companies go visit their factory, go learn what they're doing. In the 80s, when GM, Ford, and Chrysler are having a difficult time, they went and visited Toyota and figured out just-in-time inventory, looked at the robotics in their factories, the modernization in their factories, and they brought that home and modernized the American factories to compete better. Okay, so again, you have your financials backed up here, and we start over in sales again. So in year 2, I'm noticing that the customer expectation ranges have now increased. So I have to build, customers are expecting a better car. So if you look at, say, a car from the 1980s or 70s, say a Honda Accord, look that up on the internet, Honda Accord 1982. And compared to the Honda Accord today, you're getting twice the car for roughly the same price. So customers' expectations do increase. So I'm just going to build my cars again. I have to remodel them because every year cars have a new model. So I'm going to remodel my cars, and I'm going to, now here I have a low gross profit margin, and this is below my average profit margin. So if I go to overview, I see that my profit margin my gross is 45% now, 45, 26, 18. So when I'm building my new cars, I can't have a car at 37%. My investors will hate me. They'll kill me for that. So I have to lower some features here and maybe increase my price a little bit. Now this is going to, of course, you're saying, well, that's going to lower the demand for your car. Yeah, it will. But I'm not going to sell a car below my profit margin and disappoint my investors, even if it means I'm going to be selling fewer cars. So the game isn't about who can have the most sales. The game, just like in the real world, is who can have the most profits. And that's what we're trying to do. Okay, so I'm going to move to the next vehicle. And again, I'm just kind of, don't copy my numbers here. I am just kind of putting them in really quick. Okay, again, my profit margin here is too low. So I might have to pull back on some of my variables to get that back up. And I want to have a profit margin above the 45% I had. So even this is, I can go a little lower here. All right, so now I'm 49, I'm doing good. I'm 48 and 49, I'm above the 45% I had last round. And that's one of the key successes of this game, is to get your profit margin in an area where your investors will be happy, and also have a accurate forecasting. And for that, you would have to, see your student user guide to get better forecast information on how the market grows, so you can better forecast. A lot of these cars are growing above 20% each round. So you have to factor that into, how well have I sold my cars compared to my competitors, compared to the industry, and get a better idea. Just like in a real company. That's why I like this simulation. I would say it's pretty accurate to the real world, the companies I've worked in business, and what businesses looked at. We're always looking at how to increase profits, how to reduce the product cost, when can we increase prices, when will consumers accept a price increase. And I found that even this game may appear a little simplistic, but a lot of the strategy in here is pretty much what I dealt with in the real world pretty commonly. Okay, so here I also noticed that the inventory advertising expectations have increased over round one, and that's based on the levels of advertising the individual companies did in round one. So now we have the advertising costs have gone up, and as the market expands and becomes more valuable, you would expect that. So I'm going to have to redistribute my investment in my advertising again. And again, student user guide is good for giving you ideas of where your money will be most effective when you're spending it. This demographic target, it doesn't really reflect any change in the simulation. It's sort of a role-playing where you kind of make up the age and income, and that ties into the reflective observations down there. But since this is a winter semester and we don't have time for a lot of reflective observations, I'm not going to worry about the demographics too much. It's really this advertising investment area that I have to maximize. So give me a minute to do that. This takes a while, so I'm going to pause the video while I put this in, and then we'll move on to the next screen. Okay, so now we're here in production, and I'm going to I have to increase my factories. Now, you don't go and buy 4 factories when you only need 1. So that's just smart capacity utilization. So make sure you're not over purchasing your factories. And here I only need to buy, it looks like 1 factory. Actually, I buy a factory here. So I'm spending a lot of money in factories, which is okay because my sales are expanding. My capacity utilization is going to be lower because I'm building a factory here only to sell 200 cars. So that's going to hurt my total assets. I'm going to have bigger total assets than I really need. But sometimes when you build a factory, I can't just build a factory for 200 cars. So I'm going to have to take a hit on my capacity utilization and my assets. However, I'm going to invest. You want to invest in your operational investments here, because if you don't, you fall behind, because this is how companies are able to make, how Honda is able to make an Accord today that is much better and bigger with more features and better gas mileage and all those safety features and luxury features that the new Accords have that the Accords in the 80s didn't have, because they invested heavily in their robotics and technology that enabled them to build cars with less labor hours, with more quality. And this is, the operational investments. You don't want to skimp on them because you're going to fall behind your peers. So I'm going to make an additional investment in this area. So here I matched. You don't want to have any excess or shortage production. So I'm always matching my production to what my sales forecast is. If I think I'm going to sell more, then I'm going to go back and forecast more. I'm not going to, so here if I'm forecasting 2,200, I'm not going to build 2,300 because that's ridiculous. If I think I'm going to actually sell more, I'm going to go back to sales and I'm going to, increase this to 2,300 and submit that. And then when I go back to production, I guess that if you don't submit your data, you will lose it if you switch between pages. So lesson learned. Okay, so now I didn't lose too much though. So I'm going to put in my my exact production needs, and here I'm counting for I have inventory, so I don't need those 39 cars. I don't need to build to be refurbished, and so I want to make sure that my excess shortage here is 0. Now, if I don't sell everything that I forecasted to sell, I may have an unexpected deficit, and that can happen. So if I forecast 5,000 cars and I have 2,000 cars left over in my inventory, of course that's going to create an unexpected deficit because you didn't sell the cars that you had thought you were going to sell. And that's a problem. Okay, so I'm going to increase my operational investments for this round to help reduce, and that reduces the cost of building my car the next round. Okay, so go into my financials. And the first thing I want to look at here is I have a deficit, a $17 million, $18 million deficit, which means that I'm going to have to borrow some money here to cover this deficit. Okay, so that puts me at a surplus of 4. So maybe I'll issue a little stock here because, you know, I want to have a cushion. $5 million surplus is sort of a cushion, but if I don't sell every vehicle that I expected to sell, I may have a deficit here. So sometimes if you really want to make sure you get those 100 points for surplus, make this 10 million or more to cover any unsold cars that may occur. Because this pro forma is just a guess based on your sales forecast. So if your sales forecast is not accurate, your surplus will not be accurate as well. Okay, so I finished round 2, and let me just complete round 2 here. And you can see that I did it. I increased my gross profit margins, my net and operational profit margins, and I did have a small surplus, so I got 100 points there. I doubled my operational investments. I got 100 points there. And in my quick and debt ratios, I lost points in my quick and debt ratios and return my equity multiplier because I took out a lot of debt, so that increased my debt levels. So my debt ratios I lost points because they're going in the wrong directions. I'm increasing debt. Investors don't like that. And my company's less efficient because my equity multiplier, I've taken on a lot of assets. You see my total asset turnover is down and my equity multiplier is down because I took on a lot of factories and didn't fully utilize them. So, okay, so that's my run through of round 2 to give you some ideas of what you can do and how you can run round 2 in a strategic way to improve your score and points. And I've reviewed round 1 for the class to give you an idea of how each company did, and use this information to move forward and complete round 2 of the team-based practice, the team-based simulation. Now, remember, you can always go back into your practice rounds. 2 is just the minimum. If you want to do a full set of practice rounds, then you can restart and then do another set of practice rounds. So if you want to use the practice rounds as an area to test your ideas, to test different strategies out, you can do that to get a better idea how things will work out in the team-based competition. Okay, so good luck in the next round of the team-based competition, and I'll be talking to you soon.